The survey says on the initial claim side, we have a drop of 9,000 from a slightly revised 230,000, which originally was released at 229,000 last week. It now stands at 221,000. And continuing claims a week behind, a week in arrears, moved from 1.77 million down to 1.75 million. Our March read on Philly Fed, expecting a number in the zip code of 5, almost triple, 13.7. So after, of course, the Fed meeting, which many deemed dovish, I deemed a good accounting of what's going on in the economy, it's a pretty good number. But it's being received by lower, significantly in certain parts of the curve, lower yields and a lower stock market. You know, I remember, Becky, when interest rates moving higher was the bane of all equity investors. I think they're thinking twice about that at this point, especially when we now see 2.5% and closing in on the 235 mark with respect to the short and 2-year notes. Joe, back to you.
Rick, is that because of what it may be signaling from an economic perspective?
Well, I know that's the common refrain, and I read it in the Journal and all the op-eds. I completely disagree with it. It's not like, oh, we were wrong, we're reversing. They were trying to buy insurance. The globe is slowing. Investors would rather see a more patient Fed that they can feel confident is monitoring the same data they see. I just think that the Treasury complex is a tough call. How much of that is the Fed and how they change their outlook with respect to how the market becomes a more real-time signal definitely took the steam out of selling treasuries. But in the time period since the end of last year, a lot of other numbers in the U.S. and especially globally have downsized, have shown smaller growth numbers. And I think that that is the issue. I do think the transmission line and the correlations between the soft interest rates is going to have a larger effect on equities. We'll have to see how long it goes and what levels we find support, especially in the shape of the curve.